And rather than me waffle on, let's get cracking, and I'll hand you over to James Grigor. James, floor's yours.
Thank you, Hamish, and thank you, Sue and Linda as well for having me. Really appreciate everybody taking the time on a now rather dark evening in New Zealand to spend time away from probably Netflix if you're in my family, or trying to get the 7-month-old and 3-year-old to bed. But look, I want to keep this as interesting and informative, but also interactive as possible. I can see the Q&A and that sort of thing on my screen. So if you do want to virtually interrupt me and ask questions, I'm more than welcome to take questions. So what are we going to talk about today? Well, I think what's going on is really interesting, and I'm going to set the scene a little bit in a second. But what I think, the quote that I've heard most recently really resonates with how we are seeing things, in terms of how can you be so positive on share markets at the same time so negative on the economy. And so that's really the main question that I think we should explore in the next 20 minutes. And the Microsoft CEO, Satya Nadella, recently said something which I thought really describes this well. And he said, we've had 2 years of digital transformation in 2 months. And I think that's a really succinct, great way to think about what's happened. And a good example of this is how we're giving this webinar. Normally would be in Hamish, Sue and Linda's office, or the NZ Fund's office. We would have had to drive into town, find a car park. Half of us would have forgotten about it because the traffic was bad or the weather was bad or something like that. Instead, we're in the comfort of our own home, efficiently talking about investment markets. And I think that is just a little glimpse into perhaps why we can be a little bit more positive about what's going on from a financial market perspective. But shall we set the scene on what's happened this year? Because I think that's sort of an interesting way to start off with this. And I'm going to use my own experience because I feel that's the easiest way to explain a concept. But I think many other people in my seat probably had similar, if not related experiences on how they saw financial markets. And really it started for me on the 4th of January in Queenstown when I was on summer vacation, which, if you remember all the way back in January, which seems about 7 years ago, I was in the South Island in Queenstown, and the weather was terrible. It was really cold. It was a cold summer, and we were disappointed, albeit with young kids. We were sitting inside probably reading books, where I got a call from my colleague at NZ Funds, who was in the office, to say, we need to think about our portfolio positioning. The US have just assassinated a very senior Iranian general in Iraq, and the volatility in markets is just going to spike because of it. Add that the Chinese-US trade war, and add to that the US election this year, we were in for quite a wild ride in terms of geopolitical events and the financial markets. And despite those things, interest rates were low. The Federal Reserve and the Reserve Bank of New Zealand weren't going to raise rates anytime soon. In fact, they were going to stay low for quite some time. So despite the geopolitical events, we were pretty constructive, which is investment speak for positive about share markets. We then went to Hong Kong, as we do every year in January, to go to what is quite a well-known conference held by Goldman Sachs. And it's a great conference. It's all about the macroeconomic and political situation of the world, and it really resets you for the year. And sure enough, the main topics were these geopolitical events. And so what was surprising, though, is, and where we got the most benefit from that conference, had nothing to do with what we learned at the conference or the different investors and companies we met during the week. It was landing on a Saturday morning, Hong Kong time, when we first arrived in Hong Kong, to a very bustling city, huge amounts of people around. For those of you who've been to Hong Kong, it's like being in New York or London or Sydney. And perhaps 400 meters of downtown Auckland, really busy. And what we found was a city that was embracing capitalism and markets. Now, fast forward 1 week, and I'm talking about literally 7 days to when we left Hong Kong. And the streets were deserted. People who were on the streets were wearing masks. The likelihood of us even getting out of Hong Kong was starting to reduce because there was risk that the airport was closing. And this was the effects of this thing called coronavirus that was really taking hold in China. And all that happened in a week. Now, the reason it happened so fast and the city shut down so fast within such a short period of time was because Hong Kong had suffered viruses before. I think SARS was a big effect on the Hong Kong economy and the Hong Kong people. They know how to react to viruses. And the complacency was certainly not apparent in terms of the restrictions. And yes, we were starting to get a little bit nervous. Were we going to catch this virus? We were staying in a hotel. All of a sudden, the restrictions around what we could do in the hotel were starting to increase. And really, it was quite a pivot from when we first arrived. So when we got back to New Zealand, we did manage to get out of the airport, obviously, and get back to New Zealand. And then as the spread of the virus took hold, it took really only a week or so, and Italy was really affected. And it started to creep into countries that we perhaps travel, or myself at least travel a lot more prevalence to, which is the UK and the US. And it wasn't until it started spreading there, but the numbers were just really not that high. Oh, we've only got 2 or 3 cases in the US. London, we've got hardly any cases, and it's something that we're not concerned about. But using the contacts through our, investment contacts and general political contacts and health contacts we have, as you do when you invest globally, there was a huge amount of complacency in these developed markets. And the fact that they didn't have any cases wasn't a fact of there were no cases. There was the fact that they weren't testing. And I think now fast forward to now, I think we know what's happened. Huge amount of cases were actually apparent, many more than the testing was suggesting, because there were just not enough tests being done. What that experience in Hong Kong led us to do, though, is take a huge amount of risk off the table within our investment portfolios. And why did we do this? Well, in investment markets are forward-looking. And this is really important. Investment markets don't look at what's happened or what's happening now. They look at what's going to happen. And our view was that once the market started pricing in what they're going to have to do to stop the spread of this virus, they're going to go down. And I certainly didn't expect the extent of the reaction from governments, and as we got closer to our lockdown in New Zealand, absolutely, in my view at least, and I'm no expert, it seemed absolutely the right thing to do. But nonetheless, we did expect some sort of reaction, and therefore some negativity around markets. And that complacency, as the market started to realize what was happening, would be pricing it in. And that's how we think about markets, and that's the setup. And so when we then fast forward to, well, hang on a second, the economy is really, really struggling. Yes, we're opening up in New Zealand, and the US is doing a somewhat hatch job, but they are still opening up their economy. Why are share markets going up so fast and so aggressively, given 1 in 5 Americans are unemployed, 10% unemployment expected in New Zealand, maybe up to 12%, certain sectors in New Zealand decimated, around tourism and those sorts of areas. And really, again, it's this forward-looking basis in which markets look at things. Markets have a perception that with the amount of government stimulus and the amount of effort that governments and central banks are putting into the economy and the real economy, financial markets are almost saying, let's forget about 2020. But what about 2021 and 2022? How do they look? And if they look better than that things do now, then I can buy things at actually really great prices. So there's the setup. Let's have a now run through let's forget about what my face looks like. Let's now have a run through of the different things that we're witnessing and make us think about, well, what's next for financial markets in the economy. I think first and foremost, this slide, without going into the detail of what the numbers are saying, it's really interesting what this slide highlights. In March 2000, we had a bear market. Now, a bear market means markets fall greater than 20% from their highs. In March 2000, we had a tech bust with all the technology companies. But if you look at the signals that indicate we might get a market sell-off, 16 of the 17 signals were flashing red lights saying things are looking pretty ropey here. We're concerned about markets. October 2007, the GFC, yes, might not have been 16 of the 17 indicators saying we're going to have a bear market, but certainly 2/3 of the indicators that we look at were saying things are going to be a bit tougher than they have been, and we need to prepare for that. February 2020, sudden shock to the economy, as Hamish said. The echo boom is another version of events that people use, the echo boom of the virus affecting the financial markets and the economy. And the reason why this has been such a violent reaction from share markets initially and a violent rebound is only 5 of the 17 markets signals were telling us that things were going to go badly from here. In fact, as I said at the very start, we were very constructive about equities. We had no reason to believe that share markets were going to sell off. And it wasn't until we went to Hong Kong and realized this external factor was going to have a huge effect on markets that we did something about it. So the next thing people do after knowing that there's going to be a bear market is, what does the recovery look like? And really it's quite simple, although quite difficult, because it's simple in the sense that there's really 3 types of recoveries, and they are all letters of the alphabet: V-shape, U-shape, and L-shape. A V-shape is the economy recovers, if not more than if not to a better place than where we were before the crisis. And this better place perhaps comes from government stimulus or something like this. And we're back to where we started, and things have gone extraordinarily well. Maybe the reason why we've sold off in the first place is some sort of short-term phenomenon. A U-shape is like a V-shape, but perhaps a bit more feebler. Maybe there are certain sectors or geographies that are going to take longer to recover. And then we have the L-shape. The economy falls off a cliff. In this case, in this chart, we're talking about output or GDP, and it never really recovers. Now, those, when you think about coronavirus, are quite almost, in a way, easy to define. V-shape means vaccine straight away, no need for any more lockdowns. We come out of lockdown very fast, and the economy and the share markets recover very fast. U-shape, we recover. There's a lot of government stimulus, but there are certain areas of the economy that aren't doing very well. And I think this is our base case scenario, is this U-shape. An L-shape could also be caused by the fact that there's just no government support. Think what happened in the Depression in New Zealand. The reason why New Zealand went through a depression is that there was no government support, to the fact that, to the point where interest rates were actually increased in New Zealand during the Great Depression to try and strengthen the New Zealand pound as it was then. But an L-shape doesn't really factor, we think, in the current environment. And why are we confident that, despite some certain sectors, therefore not getting a V-shaped recovery, why do we think we're going to get a U-shaped recovery? And really, this is the slide of the night. This is, if there's no other slide to look at, this is why, despite the awful economic conditions caused by the effects of coronavirus and the lockdowns that we've had to go through, this is why that we remain positive, and why we think that all our investors, if they have a long-term investment horizon, should remain invested. And in fact, at the end of March, where we're at real pain in the economy and pain in the share market, where we were encouraging our investors through weekly communications to put more money in if they had the capacity to. And this is all about government stimulus. So along the x-axis, along the bottom, is the number of days, and across the y-axis is the amount of money in US dollars that the US government was pumping into the economy, either the government or the central bank or the Federal Reserve as it's called. Now, if you look at the green blocks to the right, that's the journey that the government went through during the global financial crisis. This is the global financial crisis where the financial markets as we knew it may come to an end. You know, instead of trading with cash and for goods, you know, there was even talk about having to move to a bartering system because banks were starting to implode. It took over 500 days to reach a stimulus level of about $1 trillion US. And even then, it took even longer to get anywhere even close to what the stimulus package that they've announced in the current crises. But not only is the current crisis attracting more stimulus from governments, the amount of days it took to reach 2.25 trillion has been less than 100. And that's a phenomenal achievement in such a short period of time. In fact, as medical professionals, I'm sure you're sitting there wondering, wouldn't it have been nice if the medical reaction in the US was as fast and as pronounced and as aggressive and as successful as the financial response? But again, you know, it's the free world in America, and money's king there, and perhaps maybe that's one of the drawbacks of what's been driving this response. Nevertheless, the reaction has been aggressive and violent, and this is why we don't think there will be an L shape. This is why we think that even if there is a second wave of virus throughout the developed world and emerging markets, why we think the markets will perhaps not reach the levels that they reached in March. And this is because of the amount of money entering the US economy and the New Zealand economy and our trading partners as well. In fact, on this chart, we've got almost 2.25 trillion of US dollars entering the US economy. In fact, it's now closer to 3. And some of the people that we are talking to suggest it could even get to 10 trillion by the time this is finished. And that's 50% of GDP. I mean, that's a huge amount of stimulus. And Sunil has asked a question related to this, or how are they paying for all this borrowing? And that is a fantastic question, which we have a slide on, and we're going to get there. But there is one word that enables you to pay for this type of borrowing, and it's called inflation. But let's touch on that in a second. I think in the last sort of 5 minutes or so, let's talk about other reasons why we might be positive about financial markets. The first one is, no matter what the cause of the bear market, now they might not follow exactly the same path as other bear markets we've seen since the 1960s, but they certainly rhyme. And the main thing that you can get out of this chart is the median amount of days it takes for financial markets to get back to where they were after a crisis is 200 days. That's a pretty phenomenal effort when you think about what some of the causes of these bear markets are. And I'm not saying we're necessarily going to be out of the woods in 200 days, but we are seeing financial markets right now react as one would expect. What we're seeing now is not unexpected in terms of the recovery of the financial markets. And it's the same when we talk about specifically around epidemics, but I think the more interesting one is this 1918 flu pandemic. The flu pandemic started around the end of World War I, and we saw a strong sell-off in financial markets, as you can see. But then we started getting the recovery right after the announcement of the Spanish flu. In fact, where the quote has come from, which we have discussed many a times over the past few months, the financial markets doesn't wait for the all clear signal. This is where I think that you can really take that on board as what happened in the 1980 flu pandemic. We got the first wave, second wave, and then a third wave of the flu in 1918. All the while, financial markets were increasing. And so what this says to us is that while the economy might suffer and the health effects are horrendous, the financial markets were forward-looking. And the reason they did recover in 1918 is because the amount of stimulus in the economies from the end of World War I was the cause of it. And it's the same sort of stimulus we're seeing now, but I guess in a different guise. So this gives us some reference point that we think that despite what's going on with the virus and the fact that there may or may not be a second wave, we think financial markets will continue to be very volatile, but they will be substantially higher in the next 2 to 3 years than they are now, driven by this huge amount of government stimulus. And the other reason why we're positive is if you think about a lot of the time people like me talk about the market. And what is the market? Well, don't forget the market is made up of lots of different companies. And when you have a big sell-off like we did in March, when markets were off 35%, you are able to buy companies that are fantastic, long-term, profit-generating, stable, dividend-paying companies for a lot cheaper than what they were. Think Meridian Energy in New Zealand, a great stable power generator. Yes, demand for electricity might decrease in the short term, but over the long term, people still need electricity. People still want the dividend that that company pays. And if you're not getting any return from the bank in terms of term deposits because interest rates are so low, why not buy a nice, stable, dividend-paying equity like Meridian Energy? And this is exactly what's happened. These sorts of companies like Meridian, Spark, Chorus is a great example of the digitization. I bet no one's complaining about the Chorus installer now since they've got their great fiber broadband connection during lockdown period. I mean, it's been an outstanding success for New Zealand. And so all these companies are now cheaper and we were able to buy them at greater rates. Obviously, there are some companies that you don't want to buy in periods like this, tourism sector being one of them. But being an active manager means we can pick and choose what we do. And then the final slide I guess there's 2 more slides I wanted to go over. The first one is to go back to Sunil's question around who pays for all this government borrowing. And really, government borrowing, the Federal Reserve in the US and to an extent the RBNZ, Reserve Bank in New Zealand, they have unlimited resources. They can continue to print money for as long as they want to. But by doing that, that causes inflation. And it's something that when unemployment is 20% in the US, when it's 10% in New Zealand, the thought of inflation really is unheard of. But the reason why we think it's a risk is because of this government borrowing. And again, markets are forward-looking. And what's the biggest risk to especially a retired or looking to retire investor? It's inflation. What's the worst asset class you can be invested in when there's high inflation? Cash. And so we're very, very cognizant of the effects and the negative effects of inflation and what that can mean for investors, especially those that are more conservative, that would otherwise be in more defensive assets like cash and term deposits. And so gold is a fantastic way to mitigate some of that inflation risk. And the reason why gold increases with inflation, it has a real value. It's a physical asset. And so as inflation increases, that means that the value of that gold increases as well. And so that's just one of many examples of why we think that being an active manager in the financial markets and enabling us to invest in asset classes that will do well given the environment, and gold is one of them. And I think that when you think about inflation and government borrowing and how do I invest my money or how do I think about saving, I guess it comes down to different asset classes and diversification, and not being wedded to one type of asset, not being wedded to the good Kiwi investment property and some cash. And I think gold is a good example of this. And then the last slide that I'll go over in terms of, I guess, leaving a bit of food for thought is interest rates. So why does inflation come about? Or there's a lot of stimulus into the economy. How do you fight inflation? You increase interest rates. What puts a brake on the economy? Increasing interest rates. So hang on a second, we can't have higher interest rates in New Zealand and the US and other trading partners because increasing the interest rate will stop the recovery. Central banks don't want to do this. And in fact, they are decreasing interest rates, and even talk of negative interest rates in New Zealand is something that we never would have even expected in January. And so with low interest rates, potentially high inflation, sitting in cash or even bonds can be a real detractor in your returns. And this is another reason why we're seeing equities increase in value. Look at the dividend yield you can still get in a New Zealand share, on average 4%, but think of Spark or Chorus or some of these high dividend paying companies with stable earnings. They're giving you almost 6% dividend yield. That compares to 1.75% potentially in the bank. And you can all of a sudden see why the demand for some of these shares is so high and why we stay positive within that asset class. So I think that overall, you can see how the journey took us from having an expectation of where the economy was going to go, but actually it certainly didn't turn out the way we expected. We make sure that we don't get overly positive or overly negative about financial markets, and make sure that we invest to reflect the investment regime, knowing that the markets are forward-looking, knowing that they're not pricing in the complacency around the virus, and not getting too negative when we see the amount of government stimulus being pumped into the economy, and making sure that we know what is the true driver of financial markets, and its returns. And when there's risks around inflation, it's making sure we have asset classes that defend us from that inflation, that inflation boogeyman that can potentially destroy a portfolio without us even knowing. So those are the main themes that we are looking at the moment. I think that's probably a good place to stop, Sue, and hand it back to you, and we can see if there's any question that come up on the chat.
James, yes, there has been one come up whereby Rosie's suggesting that there are a lot of other commentators out there that are saying that QE is more likely to lead to deflation. So can you comment on the impact of deflation on equities?
Sure. So I think that it's all about time horizon, Rosie. I think absolutely in the very short term, when you have an economy that has a sudden shock and unemployment, which is incredibly high, so there's slack in the unemployment rate, you certainly will start seeing deflation in the short term. And that's also, I guess, overlaid with the fact that perhaps driven not by just COVID-19, but also driven by things like OPEC, that you've seen oil really trade off and affect the inflation rate. But the amount of money that's going into the economy from governments and the amount of stimulus that's going in, and how do you get out of this inflation, get out of this economic funk that we're in, and the fact that central banks can't raise interest rates tells us that this inflation expectation is going to come along a lot faster than people expect. And I guess that's a differentiated view. I think we are far more concerned about inflation in the medium term than deflation. How does deflation affect equities? Well, deflation comes about because growth is slowing. And so you want to be in companies that are perhaps less cyclical. So a good example of a cyclical, for those of you, by the way, that can hear, it's witching hour in my household, and my 7-month-old is going crazy. So apologies for the crying in the background. But the cyclical nature of a share that's affected by deflation is things like Fletcher Building, who generally make higher margins by increasing their prices. Or think the simple companies, maybe not listed on the equity market, but things like the supermarkets. The way that they can make money is by allowing themselves to increase their prices. And you just can't do that in an inflationary environment. And I think you've added to your question that the 1980s was great for the retired. The thing with the 1980s and the high inflation rate is we also had very high interest rates, where what we're saying is interest rates can't increase because of the state of the economy. And so if you're retired and you have an inflation rate, and I'm not suggesting an inflation rate of 10%, I'm suggesting an inflation rate of 4%. But if you've got a 4% inflation rate and effectively a 0% interest rate, that's a 4% negative return on your portfolio day in, day out, every year. That's a great way to destroy wealth. But good conversation, Rosie, and great questions.
I must admit, I was one of those many people in the late 1980s that had a mortgage paying 22, 24%. So I think New Zealand's economy might be in a slightly different position if that was the interest rate at the moment. Just really quickly, James, which I know is difficult, but with high government borrowing, is it likely that taxes will increase and also affect on the value of the New Zealand dollar?
Well, I think the cause of what will be the government's response really comes down to a political outcome. Really, you know, if I look to what's happened in the UK after the global financial crisis and high government borrowing, they decided to keep taxes firm but go through austerity, and which means, you know, really reduce that government spending. And I think that that's one way. The other way is to think about increasing taxes on certain parts of the economy. I think, and that's all really, you know, to do with what your political persuasion is. I think what's interesting in the US is the Democrats are more likely to increase taxes dramatically on the 0.1%, whereas the Republicans are more likely to cut government spending. In New Zealand, I think it's probably more evenly balanced. I think we'd all agree that our politics, thankfully, or my opinion, thankfully, is pretty similar, whichever route you go down in terms of, you know, on that real key fundamental issues around taxes. And it might not seem like that, but I suggest if you disagree with me, go and look what's happening in the US and the UK. And I think that, you know, we'll probably get a bit of both, a bit of government austerity in certain parts of the economy, but also potentially the raising of taxes in certain areas. But I think one really important point about this, and I'm getting to the points here, I promise, is where are the government going to cut expenses? Because they're certainly not going to cut health spending. I mean, that would be astronomically, I don't even know if that's a word, that would be absolutely disastrous for a politician, for a party to cut health spending during a coronavirus crisis. Are they going to cut it in benefits? Well, you've got a huge voting bloc who are now unemployed. I doubt they're going to cut benefits. And in actual fact, benefits in terms of unemployment benefits are actually not that big a part of the economy. No, the biggest area of government spending, in my view, and that is at risk of being cut, is superannuation. It takes up, I think, about 25% of government spending. It is the largest part of the government spend, and our retirement age has always been sort of looked upon by politicians as unable to be touched. And I think this will probably, in my view, cause a rethink of that. And with the fact that we have KiwiSaver as well, you might really start seeing a cut in superannuation, state superannuation. Now, I might be sounding like I'm talking my own book, but what that does mean for us, the public, for us that are perhaps a little bit further away from retirement, because, you know, these things do take a while to come through, is that we really need to start thinking about our own retirement plan and our own retirement savings. And is KiwiSaver with 3+3 enough to retire on, if you also model in the fact that you're not going to get probably a state pension anywhere like the amount that we're currently getting? And I think that's where the risk is. And we really need to start thinking about saving more of our own money to sort of fill that void. So on that, I'll